In 1970, the average home cost roughly twice what the average person earned annually. Today, it costs 7 times that amount, and the gap keeps widening every year. The numbers didn't drift by accident. Something structural changed beneath the surface of the market. The common story you hear now goes like this. Wall Street bought up all the homes. Families got priced out, investors got rich, and that's why housing costs so much today. That story is emotionally satisfying, but it misses the timeline and reverses the cause and effect. Institutional investors didn't break the housing market. They responded to a market that was already broken badly. And understanding that difference changes everything about how you see what's happening now and what might work. Here's what actually happened, step by step, without the outrage or the oversimplification that usually follows. Large investors have always bought real estate. That part isn't new at all to the system. For decades, institutions owned apartment complexes, office buildings, shopping centers, warehouses, and industrial parks across the country. What they didn't do at scale was buy single-family homes in suburban neighborhoods one by one. That changed after 2008, and then again after 2020, for reasons most people never actually hear explained. After the 2008 financial crisis, millions of homes sat vacant after foreclosures swept through entire neighborhoods. Prices collapsed in markets like Phoenix, Las Vegas, Tampa, and parts of the Sun Belt rapidly. Families couldn't get mortgages. Banks had tightened lending standards dramatically after losing billions on bad loans. So homes sat empty, and prices kept falling with no clear floor in sight anywhere. At the same time, interest rates dropped to near zero as central banks tried desperately to stimulate. Institutional investors, managing billions in capital, suddenly faced a problem they'd never encountered before at this scale. Bonds paid almost nothing. Stocks felt risky after the crash, and cash just sat there, losing value. Real estate, especially distressed real estate, started to look like one of the few things offering yield. So funds stepped in and bought thousands of foreclosed homes in bulk at steep discounts nobody else could. Not because they wanted to displace families, but because families weren't buying and couldn't get financing anyway. The homes were already empty, the prices were already collapsed, and somebody had to absorb the inventory. That's the part that gets left out of most versions of this story you hear online. Institutions didn't push families out in 2008. Families had already left or lost their homes to foreclosure. What institutions did was turn those vacant, deteriorating properties into rental housing at industrial scale efficiently. They hired property managers, standardized maintenance, created systems, and rented them back to local residents who needed them. For years, that was the story. Institutions owned a small percentage of single-family homes nationwide, maybe 2%. Not enough to move markets, not enough to set prices, just enough to be profitable in specific metros. Then 2020 happened, and the dynamics shifted again in ways nobody fully anticipated at the time. Interest rates dropped even lower, almost to zero, and stayed there for over a year straight. Trillions of dollars in stimulus flooded the economy, much of it landing in savings accounts and markets. Inflation started ticking up, and suddenly real assets, things you could touch, became extremely attractive to institutional capital. Housing, specifically, became something Wall Street had never quite seen it as before at this scale. A bond-like asset that generated predictable monthly cash flow, appreciated over time, and hedged against inflation naturally. So institutions scaled up, not just buying distressed homes anymore, but competing for regular homes in regular markets. They brought cash offers, waived inspections, closed in days, and beat families who needed mortgage financing consistently. This is where the anger makes sense, because now the behavior feels predatory even if it's rational. A teacher saves for years, finally has a down payment, makes an offer, and loses to an algorithm. The home sits empty briefly, then gets listed for rent at a price higher than the mortgage would have been. That experience is real, it's frustrating, and it's happening in metro areas across the country right now. But here's the statistical nuance that matters if you want to understand what's actually driving prices overall. Nationally, institutional investors still own only about 2 to 3% of all single-family homes in America. That number sounds small, and critics use it to dismiss the entire institutional investor narrative as overblown media hype. But in certain metros, Phoenix, Atlanta, Charlotte, Tampa, that number jumps to 15, and at 20, even 25% locally. And in those markets, during peak buying seasons, institutions were making 1 in every 4 purchases in 2021. Both statistics are true simultaneously, and both matter, but they describe different layers of the same problem. Here's why the local concentration matters more than the national average for understanding price dynamics in real time. In any market, it's the marginal buyer, the last person willing to pay, who actually sets the price. If institutions are consistently willing to pay 5 or 10% more, then families can afford competitively and reliably. Then prices rise to meet that new ceiling, even if institutions are only a fraction of total ownership. So yes, institutions amplify price growth in the markets where they concentrate. That part is observable and measurable. But they didn't create the underlying conditions that made housing unaffordable in the first place for most families. Those conditions were building for decades before Wall Street ever noticed single-family homes as an asset class worth pursuing. Here's what actually broke housing: the factors that created the crisis institutions later stepped into and now reinforce. First, chronic underbuilding that started after the 2008 crash and never really recovered to historical construction rates. For over a decade, builders built fewer homes than the population growth and household formation rates actually required. Permits slowed down, construction crews shrank, lending for new development stayed tight, and supply fell behind demand steadily. Second, zoning laws and NIMBYism that made it nearly impossible to build affordable housing in the places people wanted. Single-family-only zoning locked up huge portions of desirable neighborhoods, blocking duplexes, townhomes, and apartments from being built. Existing homeowners fought new development because it threatened their property values, their views, their school districts, their quiet streets. Every new project faced years of regulatory battles, environmental reviews, community meetings, and legal challenges that added costs. So developers stopped building starter homes and entry-level properties because the margins were too thin to justify it. Instead, they built luxury units, high-margin properties, and homes that investors would buy, not families struggling to enter. Third, ultra-low interest rates distorted asset prices across the board, not just housing, but everything financial globally. When money is nearly free to borrow, prices for anything that generates yield rise until the returns normalize. Housing became one of the best inflation hedges available, so capital flooded in from everywhere, not just institutions. Individual investors, foreign buyers, second home purchasers, everyone with access to cheap capital started competing harder for limited inventory. Fourth, population and job growth concentrated in a small number of metro areas, creating demand pressure nobody planned for. Austin, Phoenix, Nashville, Raleigh, Charlotte, Tampa, these cities grew faster than housing supply could possibly keep pace with, organically. So by the time institutions scaled up their buying in 2020, the market was already severely constrained and overheated. They didn't cause the shortage, but their participation made it harder for families to compete in already tight markets. When we follow this further on Luxona Vault, we trace how tax policy reinforced this entire dynamic quietly. Mortgage interest deductions, depreciation schedules, 1,031 exchanges that let investors roll properties indefinitely without paying capital gains taxes ever. The tax code doesn't just allow institutional ownership, it actively rewards it with advantages families can't access at scale. But here's the part that makes this conversation uncomfortable for people who want simple villains and clear solutions. Professional institutional landlords are often better landlords than individual amateur landlords who own one or two properties casually. They respond to maintenance requests faster, they follow legal processes more carefully, they're less likely to evict arbitrarily. They have systems, standards, and reputations to protect, which creates accountability that informal landlords sometimes lack completely. That doesn't make the system good, but it does mean the experience of renting from an institution isn't universally worse. It's a system-level outcome, not a moral judgment, and ignoring that nuance makes the conversation less honest than needed. So where does that leave us in understanding why housing is unaffordable today and what's driving it forward? Institutions didn't create the crisis, but they now amplify it in the metros where they've concentrated their capital. They're rational actors, responding to incentives the system created. Cheap money, restricted supply, tax advantages, predictable yields, and inflation protection. Blaming them feels satisfying, but it misses the structural forces that made their participation both possible and profitable initially. The real drivers are zoning laws that block supply, interest rates that distorted prices, underbuilding that lasted over a decade, and tax policies that reward ownership at scale more than ownership for use and family stability. Here's the reframe that changes how you see the entire housing market from this point forward permanently. The housing crisis isn't a crisis of bad actors. It's a crisis of broken incentives operating perfectly within a flawed system that was designed decades ago for a different economy, different demographics, and different financial conditions entirely. Institutions are a symptom and an accelerant, but they're not the disease itself, causing prices to rise everywhere. And if you only focus on the symptom, you'll miss the deeper mechanisms that need to change structurally. Some stories don't fit the shorter frame we're working with here on the main channel right now. On Luxona Vault, we slow down and follow the incentive chains further. Zoning politics, lending standards, tax shelters quietly. The full architecture of how housing became financialized and what that means for the next generation trying to build wealth the way their parents did or thought they did, before the rules changed underneath them silently. This is one lens into why housing is unaffordable, but it's not the entire story by itself. Housing is a system problem, and systems have multiple pressure points operating simultaneously across time and geography. Future episodes will explore other angles: zoning reform, supply constraints, demographic shifts, potential solutions that might actually work at scale. Welcome to Luxona, the Netflix of finance.